Hello. We're starting our segment with a summary of the most important financial market news for September 25, with our expert Melvin Koc.
Hello, Charlotte. This is a summary of today's most important market news. For the second month in a row, Chinese automaker BYD has outsold Tesla in the European market, a direct blow to Elon Musk's giant that once looked unstoppable. Meanwhile, Stellantis breaks its negative streak and returns to sales growth, sending a clear signal that the battle for the future of electric cars in Europe is hotter than ever. The big question now: is this the beginning of Tesla's decline in Europe, or just the first major offensive from its global rivals? Wall Street is in shock. A new Bank of America survey reveals that wealthy US and Asian investors are ditching American hedge funds and rushing to Europe and the Middle East. Nearly half of those who once planned to bet on US hedge funds have now abandoned them, a massive red flag for the industry. Europe has become the big winner, with allocations jumping beyond expectations. And the hottest destinations? Abu Dhabi and Dubai, where global hedge funds are setting up powerful new bases. Big players managing over $10 billion are pushing into exclusive separately managed accounts, and institutions like pension funds and sovereign wealth funds have already poured $37 billion into hedge funds this year, the biggest inflow since 2016. But that's not all. US equity funds just saw record-breaking weekly inflows of nearly $58 billion. Is this a sign of a global money shift, or the calm before the next financial storm? With stock indexes near historic highs and volatility persistently elevated, investors face a key dilemma. Is this the start of a structurally more dynamic market, or the prelude to a sharp correction? Many analysts increasingly believe this market effervescence could be the new normal, fueled by unprecedented capital inflows, the rise of artificial intelligence, and generational shifts in investment habits. Still, the memory of past bubbles creates tension. Dr. Elena Vargas, chief economist at Strategic Capital Advisors, argues that debating whether we are in a bubble is sterile and biased. Instead, she stresses the importance of analyzing the balance between bullish momentum and underlying fundamentals with more precise tools. Experts recommend shifting the focus to alternative indicators. Capital flows by sector, tracking whether liquidity is concentrated in areas like tech, green energy, or crypto, or spread across markets. Retail versus institutional participation. The surge of small investors via fintech platforms provides critical insight into the rally's strength. Relative valuations versus bond yields. With high interest rates, equity valuations should be assessed against government bond returns, offering a more nuanced perspective than simple P divided by E ratios. The consensus among fund managers. While this new normal means higher volatility and valuations, prudence remains essential. Rigorous diversification and constant monitoring of these tension points are key. As Javier Monsalve, CIO at Nordic Wealth, states, the real question isn't when the bubble will burst, but how to position yourself to capture momentum while actively managing risk. In today's market, agility is rewarded, complacency punished, and adaptability is the investor's greatest asset. Attention traders. Fidelity just dropped a bomb on Wall Street. The firm has launched Fidelity Trader Plus, a brand new platform with real-time charts, customizable analytics, and exclusive tools for the most active investors. And here's the game changer. It will come with many advantages, low costs, and an extremely low minimum capital requirement to open your account. With this move, Fidelity is taking on Robinhood and Moomoo, who are also reshaping how retail investors connect, share strategies, and play the markets. At Money Borders, we explain why this battle for the retail investor could redefine the future of digital trading. Subscribe now and don't miss the next big moves on Wall Street. Incredible! Artificial intelligence is about to unlock billions of dollars for the largest retailers in the United States. With the AI boom, major retail giants could see unprecedented profits, completely transforming the way we shop and sell. This surge isn't just about efficiency, it's about reshaping supply chains, personalized marketing, and customer experience on a scale never seen before. Experts warn, companies that adopt AI quickly could dominate the market, while those slow to adapt risk being left behind. From automated logistics to AI-driven sales forecasting, the potential impact is massive. The big question everyone is asking: are we witnessing a retail revolution that could change the US economy forever? And which companies will become the next billion-dollar winners in this new AI-driven era? U.S. Trade Representative Jamieson Greer stated on Wednesday in Kuala Lumpur that the United States expects to finalize trade agreements with some Southeast Asian countries in the coming weeks, according to Bloomberg. With the implementation of higher U.S. tariffs in August, short-term trade figures are already revealing tangible pressures on ASEAN countries. For example, Malaysia's exports to the U.S. fell by 17% in August, according to Bloomberg. This figure directly reflects the impact of adjustments in U.S. trade policy on ASEAN, And the impact of the tariffs is not limited to trade alone. Let's analyze the terms of trade agreements previously reached between the U.S. and other countries. For instance, under the U.S.-Japan Trade Agreement, the U.S. will apply a base tariff of 15% to almost all imports from Japan, along with separate sector-specific treatment for automobiles and auto parts, aerospace products, generic pharmaceuticals, and natural resources that are not available or naturally produced in the U.S. Japan, for its part, will provide U.S. manufacturers in the industrial, aerospace, agricultural, food, energy, automotive, and industrial goods sectors significant market access opportunities in key sectors. Japan is also working to accelerate the implementation of a 75% increase in purchases of U.S. rice and agricultural products totaling $8 billion annually, according to the executive order. That's all for now. We'll be back in the studio, Charlotte.
Thank you, Melvin, for your report. Subscribe to the channel so you don't miss our financial updates, and give us a like if you found it useful. See you next time.